So I think this sums up the attitude of the markets this week, or the past few weeks. This is going to be a longer video, so I'm going to kind of cut to the chase. I promise they won't be like this every week, but the next couple of weeks look like they're going to be pretty involved. So this was my first down week of the year. Uranium did get the better of me. I added 2 new positions. SILJ, which is Silver Miner Junior ETF. And quickly on that, I mean, if you just looked at just glance at the top 10 holdings and compared that to the SIL of the more reputable gold or silver miners, then you'd realize that they have a 25% stake in wheat, tin, precious metals. And I don't like that kind of exposure. I discussed that, I believe, last week with the comparison between URA and URNM with the concentration of Cameco in the top 10 holdings. I really don't want that. I don't buy a basket to be concentrated in the first name or two. And then the other position I added was LEU, LEU as I'm pronouncing it, and that's Centrus Energy, and I'm not really going to touch upon that today too much, but those are the additions. Rigs held up well, BTU is holding up well, uranium not the best, and that's where we're at with that. So, excuse the long-windedness here. In week 3, I mentioned my suffering of FOMO. In recent time, I've been fervently reading about uranium. As I've noted before, I started to heavily look into the sector back in March of 2021. I've known of the primary production supply-demand imbalance for years. The Russian invasion wasn't even much of a catalyst for me, but more of a ruminating on it for months beforehand. That matters because as a human, I'm subject to anchoring bias. My recent purchase of LEU, Centrus Energy, in part is a consequence of those price points from back then. My purchasing was calculated by that, but that presupposes that that was rational. I knew if the prices went up anymore, I wouldn't participate due to that anchoring bias. I also suspect a run in these names in the future, but I also know the market has advanced ridiculously in the last month and we need to take a breather. I fully expect and expected when I made the purchase that I would be a temporary bag holder. So far, so true. As of now, uranium is a substantial position of my portfolio. It won't stay that way. $42 a week inflows will change that. My FOMO was in not having a starting position, as I will buy the dip if a sufficient dip occurs. The final determining factor that forced my hand, other than the debut of Oliver Stone's nuclear among the global elites at Davos, among the World Economic Forum, and the continual proving that wind and solar aren't sufficient baseload energy sources and are increasingly becoming more expensive, was, silly as it may be, the technical chart pattern. Whatever you wish to call it, a wedge, pennant, or triangle, the risk to me seems to be in not being involved in the upside. Although I know I'm buying on short-term overbought technicals in a market that's gone silly with such examples as Carvana and Peloton. Here is a very simple chart drawing. Of course, technicals aren't a means to an end, but part of a comprehensive and more integrative strategy. But there's something worth paying attention to nonetheless. In case you're wondering and need a visual illustration of what I'm talking about, here it is. What are we in for? So this is going to be a heavily dominant uranium review, but it's going to tangentially go into other areas. So here's a couple of companies and their valuations, let's call it, on a rating card system. On the left we have Denison Mines, and on the right we have Cameco. And what you see is they just get Fs across the board. Pick and choose. These aren't the only ratios, these aren't the only metrics, these aren't the only way of going about things, but they are things to pay attention to nonetheless. And well, quite frankly, it's shit. So what's my point? My point is that these companies aren't cheap. There's great risk in them, and we're trying to time the market. Uranium miners are a leveraged derivative on the underlying commodity and often come with horrible balance sheets. These are not buy and holds and look back on them in 10 years. Macro tailwinds plus sentimental market participants is what we're trying to arbitrage. LEU, Centrus Energy, has a great story, real work that needs to be done, but I would never put it in my retirement account. You wouldn't buy these businesses, not just Denison or Cameco, but primarily the majority of the players in this sector. You wouldn't buy them if you had to sit down, look at the financials, hire a lawyer, and do the paperwork. Because you might be asking questions like, how would I recoup my money? But you buy them in a detached manner in a brokerage account, betting on fund flows and the greater fool's theory to run the price up in a sentimental hype. Yet again, you would look at the books of these companies and you wouldn't touch them with a 10-foot pole. And yet, people want to talk about Warren Buffett and value investing. What I'm doing is asking for you to be honest with yourself. You saw this during 2020 and 2021 as value funds were slowly giving in and capitulating, adding shitcodes, Ponzi's, frauds, pumps and dumps, whatever you want to call them, to their portfolio. At first in small size, and then before they knew it, half their portfolio were in these stock promotes. They started talking about total addressable market and historical price to sales ratios, research and development, and how that might pan out in the 10-year future forecast that they offer you, using phrases like world class and once in a lifetime opportunity. Essentially, just picture an ARC slide deck. They weren't talking about EBITDA multiples, gross margins, operating margins, net income, or all the stock-based compensation and at-the-market dilutions that they were offering. You might be quick to say, look at these fundamentals. And although I agree with you, it raises the question as to what is a reasonable valuation. It's rare to see value guys talk bad about growth guys to then only become what they once criticized, but cognitive dissonance is powerful. This is part of a slide deck of Centrus Energy and their LEU operation in the United States and how they're pretty much being subsidized and backed by Bill Gates and the United States government, but we're not going to really get into that. But you could point at this and say, wow, isn't that impressive? 1 billion long-term book order through 2030. Well, do a discounted cash flow model on that and see where that gets you. Anyway, here's a company, Builder's First Source. One I've been eyeballing, but seemingly is never going to pull back. Of course, I say that only half-heartedly. And it gets all kinds of great ratings. I wish I had these kinds of grades in school. So this is considered because it's a wholesale distributor of to the home building market is what it is. And it's considered, and since I've always known, a risky stock. And it's risky because it's cyclical. And therefore, it's cheap for a reason, which is why it never gets a high PE ratio or a price to cash flow ratio or a high EV to EBITDA multiple or however else you want to evaluate these things. And I mean, that's the story, that's the narrative, that's the general consensus that people tell you. It's a wholesale distributor of building materials. Yawn, how not exciting. Who wants to participate in that, right? But if you look on a 10, 5, 3, or 1 year time horizon, it's outperformed the S&P 500, the SPY. And it's outperformed it by a very large amount. Even if you bought after the 88% run-up that was the result of the ProBuild acquisition back in 2015, you would still be outperforming the S&P 500. And that's even once you take into consideration if you bought the SPY at the near the 09 bottom, 2009, after the great financial crash bottom, you would still be underperforming Builder's First Source. It forces you to beg the question as what people mean by risk, and what do you mean by risk when you say something is risky. Here's other couple of companies that you might be more familiar with, such as Microsoft and Google. And you can see the kind of grade scorecard rating that they get, which isn't that good. And then, if you look at them though, over a long-term timeline, they also have greatly outperformed the S&P 500. But hold up, they have poor ratings, and then the uranium names have poor ratings, but to conflate categories and falsely equivalent them to one another would be a mistake. So what have we learned so far? Know what risk means to you. Don't kid yourself in what you own. Know that some securities stay cheap while others stay expensive and can get even more expensive, and that the earnings multiple you assign to it can make all the difference. Know what you're buying and why you're buying it. There's incredible opportunity out there, some in the short run and some in the long run. A narrative can keep afloat a hope and a dream, and fundamentals can come to matter again once the narrative loses strength. Just look at Peloton and what happened over the past couple of years with that. I know what I'm getting into are expensive stocks. Even in the basket approach with the Sprout Miner ETF. Now here are some differentiating factors, secular versus cyclical trends. If you look at a longer term chart, you can see that CCJ Cameco has been essentially dead money for 23 years. Unless you got in and out at the right times. And let's not kid ourselves. Pretty much anybody who's in the uranium sector, or many sectors for that fact, are trying to time the market. But if you're deluded enough to be a buy and hold investor because you think that secular tailwinds, and maybe I'll be proven wrong in 10 or 20 years here, and this time will be different. But if you just buy or average down, I suppose maybe if you dollar cost average your way through these 23 years, you'd be up. And if CCJ's dead money, then what does that make quadruple U? Well, embarrassing to be holding it is what that would make it. And that's the problem with the buy and hold and buy the dip for long term, because you would have fared well, say you put in $50 every week on Cameco for that timeline, but had you done the same thing with energy fuels, it wouldn't be looking too pretty. Now, the reason people buy uranium miners, or any miner for that fact, is because if you get the inflection right, both up and down, because selling is probably harder than buying, you can make Microsoft and Google, quote unquote, safe gains in a fraction of the time. As you can see by these charts, we're talking hundreds of percent in a year or two's time. Percents versus real dollars of UEC. Now this is going to be a fantasy world, but we're going to treat it that way to make an example. If you time this all perfectly, and who's not going to have paper hands after a 1,700% profit, but anyway, and stomach a 42% 6.5 month pullback to make 1,200%. So if you bought at the perfect time at the bottom of 2009 and you held it perfectly to the top, you would have made 2,900% in 2 years' time. Okay? You can make 2,900% in 2 years. But in that process of making 2,900%, you would have had to stomach a 42% drawdown that lasted 6.5 months. But you would have had to suffer a drawdown from 1,700% in the money and taken down to 952% in the money. And you wouldn't see new all-time highs for 10 months. To think that you can manage all of this is highly unlikely. So the probability of you actually capturing that 2,900% move is unrealistic. Now that doesn't mean you can't capture a 500% move, and a 3x or 5x in a couple years' time is pretty good returns, so don't beat yourself up too much. But this is the stuff that the newsletter people don't tell you about, how, last cycle you could have made 3,000% in 2 years. And it's like, theoretically, but that's why it's theoretical and not practical. Now, yet again, you might be able to capture a 3 or 5x 10x return. Please be mindful also of how percentages work. Buying in at the bottom of that 42%, 6.5 month pullback, and holding until the tippity top would have not produced you with a 1,200% return, because if we go back to the last slide, from the very bottom to the very top over that 2-year period, you would have made 2,900%. But what would have happened was you would have been up 1,700%, and then the market would have pulled back for 6 months, and then you'd only be up 900%. And then you would have had to be recouping back to that at that point all-time high for another 4 months. Okay, so let's say you bought at the tippity top between 2009 to 2010, and then you sold. And then you got back in later in 2010, and you bought again, okay? And then you held that until the very top of the cycle in November of 2010. You would not have made 1,200%. That 1,200% return is only for those that had the much lower cost basis. This is a hazard, by the way, of trading around positions and of the necessity of getting in early onto an inflecting sector. Yes, the dollar returns could be the same, but the percentages will not be the same. As you see here, instead of 1,200%, had you purchased at the bottom in late 2008, early 2009, if you held all the way through, you'd make 2,900%. And that last big move up that's pictured in this picture, in this graph, you would have made 1,200%. But had you actually bought there and rode it up, that'd be 189%. So there can be a person, and you, maybe one of the more important lessons to take out of all of this is you can be listening to somebody that you respect and follow, and then they can say how they've made 1,200% returns. And in that same time period, had you bought exactly at the bottom, you would have had 190% return. Both can be true, and you both could walk away with the same dollar figure, but the percentages will not be the same, and the percentages in this case sound a lot more impressive. Just because an industry is improving, and this pertains quite well to uranium here, just because an industry is improving doesn't mean that the stocks are going to do well. Take the cannabis bubble a couple of years ago into consideration. They were selling $1 to make 90 cents to gain market share while the industry was flooded with capital. Their fixed costs stayed the same while their operating losses went parabolic. As they all ramped up production, they flooded the market and squeezed what margins were available out. Just look at the Constellation brands having to take a goodwill impairment of $1.73 billion on their investment in Canopy Growth Corp, ticker symbol CGC. A company can be doing well in a so-so unexciting industry like Builder's First Source, the wholesale distributor that we talked about earlier. So what's my point? Buying stocks at fairest value, which by the way these uranium stocks are not, but buying them at fairest value gives you a margin of safety and helps you not get hurt. The time to buy Paladin was when it was left for dead, which is why no one bought it. By definition, really no one's buying it. That's what makes it left for dead. This is all to say that things are complicated and why the success rate of outperformance in the equity markets is low single digits. And if you're not going to buy it cheap, you better make sure there's a positive set of catalysts, not just one, but a set of catalysts that will make it look maybe kind of justifiable, like making projections 5 or 10 or 2 decades out. At least do a decent job post hoc rationalizing your bull case. Many of these uranium miners have negative gross profits, negative operating income, and negative net income. UEC didn't have revenue for years. There's no margin of safety buying here. Either uranium inflects, or continues to inflect, I should say, and a rising tide lifts all boats, or my boats are going to be taking substantial losses. Now, in all fairness, this is me defending my ego here, but this channel was created January 1st, 2023. My best time to have purchased these stocks would have been January 1st, but I was buying other businesses. And in all fairness and honesty, I would not have purchased Paladin at 5 cents a share. So From a value perspective, the time to buy Paladin would have been when it was trading at 5 cents. But who in their right mind would have bought them among a whole set of other opportunities? Another thing the newsletter sellers don't ever mention, which is why their theoretical returns are just that, theoretical. In all fairness, I'm quite bullish on offshore oil, and their value, quote unquote, is terrible. This leads to trailing 12-month earnings versus forward 12-month earnings, and is one of the many things that makes inflection investing frustrating. On the left, you see RIG, Transocean. On the right, you see BTU, Peabody. One of them pretty much gets an F rating, and one of them gets an A rating. But I wouldn't be surprised when it's all said and done. I'll make more money off of something that's graded to failure. But we'll see how the dividends manifest themselves in the coming quarters with Peabody, or if tragedy strikes, or who knows. Value traps and growth traps. What happens? Oftentimes, the value, you see this in a lot of the Cathie Woods type stocks. What happens is the value doesn't materialize. It doesn't mean that the business isn't growing. It doesn't mean the revenues aren't growing. It doesn't mean that they're not gaining more adoption. It doesn't mean that the total addressable market isn't growing and therefore market share can grow. It doesn't mean any of that. But you are a shareholder. So what you care about is earnings per share. And often what happens is that the earnings per share don't materialize. And a couple of the big reasons is the dilution of the shares. The earnings can grow up, but if the shares go down quicker than the earnings go up, then what you have is dead money or dying money. Because the stock-based compensations and at the markets just keep on eating away. And the earnings can't outpace it. And when the earnings do and they get a pop-up on an earnings report, they just do another at the market and dilute shareholders even more. You saw a lot of this happening in 2020 and 2021, where stocks would go up 10% on the day after a share issuance occurs. So these are the Zooms of uranium, but many of them are worse. I think Zoom, I could be wrong here, got up to 90 times price to sales. Some of these, I'm not saying this is the correct or incorrect way of valuing these companies, but upon this level of analysis, some of these uranium miners are in the hundreds. They're in a positively inflecting industry, but they're not cheap. I get tired of people saying, I saw one have a 70% upside target on like a EV to EBITDA multiple or something like that. And it's like, you really have to get fanciful and pull and really do a lot of mental gymnastics. And who's in uranium for 70%? I mean, seriously, people, it's ridiculous. If that's all you think you're going to get out of a stock in uranium, then it's probably best not to participate, because you're going to probably have a down 50 or get zeroed out in a name, which is why playing a basket of them is important in my opinion, or just playing the physical commodity. But to say a 70% up target is absurd. Like, that's not going to be enough to make up for your losers. And there's going to be idiosyncratic risks. So they're not cheap. These stocks aren't cheap. Now, SRUUF, the physical commodity, yellow cake, things like that, those trade at a discount to NAV. Those can be cheap. But I'm not really discussing that here. I'm talking about the miners. And I don't really care much for the argument between value and growth, because those are really just placeholder words for other words that people are too inarticulate or too lazy to speak to, and then they get bastardized and manipulated, and it's all silly. And as a GARP guy, which is growth at reasonable price, it's an acronym, I guess I should have put some dots in there. You're wanting a value stock with growth. I mean, it makes sense if you sit down and explain that to everybody. Like, I don't know anybody, very few people, that would say that they don't want value or they don't want growth. Anyway, I don't want to get too distracted in that argument. But things like backlog, utilization rates, day rates, new build orders, of total fleet, things like that when it comes to the offshore sector matter. And that's also why real-time data versus 12 months ago data matters, which is why trailing 12-month earnings can look atrocious, but the stock's doing well. And you can say, well, that doesn't make sense, but that's because they're two different worlds. That's the whole inflecting, that there's a phase shift that occurs. Final thoughts, a couple more slides. Even if you think that uranium can get back to its all-time highs of, we're calling that 140 back in June of 07, doesn't mean that the shares will reach the same price from back then. You have to factor in that many of them have diluted their shares 10 times over. I see people talking about how rig Transocean might get to its all-time high. But then if you look at it on an earnings per share basis or a market cap basis, it doesn't have to get, I think $70, I could be mistaken here, but I think $70, no, I don't want to say, I've lost confidence is what I was going to say. But it doesn't have to get close to its old all-time high for it to have the same market cap again, or for it to have the same earnings per share. And so people look back on the charts and think, oh, if things get as good in the industry as they were then this stock price will match that stock price. But life's a complex dynamic system and multifactorial. You have to consider more than a basic modeling of the world like that if you want to have a chance of being in the top percentage of successful traders, or just really I should say not losing all your money. I'm playing a dangerous game here, which by the way is why I'm trying to position size it correctly. I suspect I'm going to have to stomach a serious pullback in the near future, but the risk of not being involved outweighs the risk of that pullback. The whole market has gone up in the last month in an unsustainable way, including some of my own names. But look at these names. Lucid is up 102%. Now this was from a day or two ago, so I don't know, the market didn't do well on Friday, so excuse me for that. Peloton up year to date 115%. Carvana up 248% year to date. So with that said, hopefully in the coming weeks, we can start separating the wheat from the chaff and see how things play out, or coming weeks, coming quarters, and hopefully my names, I don't want to say hopefully, I do believe this, I don't think the whole market's gone up. So that brings pretty much everything up with it. And then if the market goes down, then that puts selling across the board. But that doesn't mean that there can't be divergences in the market. As far as I'm concerned, which is why I'm positioned in the names I'm positioned, I do suspect that divergence will occur. And with that said, thank you for listening.